Imagine for a second that you could, like, plug directly into the collective nervous system of millions of people all at
Yeah.
the exact same time.
Oh, wow. Yeah, that would be intense.
Right. Like you could instantly read their panic thresholds, their risk appetites, or just their sheer unadulterated greed, all firing off in real time.
It sounds like some high concept science fiction movie.
It totally does.
Blech.
But that is precisely the data feed we process every single day when we look at financial charts. So, welcome to today's Deep Dive.
Glad to be here. We've got a lot of ground to cover today.
We really do. We are looking at a stack of 9 technical setups,
Yeah.
specifically zeroing in on the Pakistan Stock Exchange, the PSX, and we captured this data today, August 4, 2026.
Yeah. And just to be clear, right up front, we aren't here to give you financial advice or tell you how to manage your portfolio.
No, definitely not.
We are doing something, well, far more analytical. We're stripping away the noise to see how capital flows are exposing the actual underlying mechanics of this market.
Okay, let's unpack this, because before we can diagnose the bizarre divergences we are seeing in individual equities today, we have to establish the macro weather pattern.
Right. The big picture.
Exactly. We need to look at the KSE-100 index. And, I mean, looking at the intraday data, the climate out there is intensely hostile.
Hostile is honestly putting it mildly. The KSE-100 benchmark is currently sitting at 177,083.22.
Which is just a brutal level today.
It really is. It has been taking an absolute beating all session. It's down 11,116.80 points, which is, roughly a 0.63% haircut.
Yeah.
But it's the structure of the drop that is so aggressive. It's not a gap down. It's a sustained intraday bleed from an opening high north of 178,700.
And that structural bleed is exactly what caught my eye, too. I mean, when you zoom into the 4-hour chart, the distribution is just undeniable.
Oh, absolutely. The volume tells the whole story.
Right. You've got these massive, heavy red volume candles just pulling the index back from that recent peak where it was testing 190,000. It looks like heavy institutional offloading.
It really does look like the big players are heading for the exit.
But I want to contextualize this.
Yeah.
Because looking at a 4-hour chart in total isolation it can induce vertigo.
Yeah, you lose all sense of perspective.
Exactly. If we pan out to the 1-year change, the KSE-100 is still up a staggering 24.66%.
Right, which completely changes the narrative. It goes from a panic sell-off to more of a mechanical correction.
It's like climbing a massive mountain. You're up nearly 25% in elevation over the year, a brutal, relentless ascent.
Yeah, a huge climb.
But today, you hit this treacherous patch of loose scree, and you just have to sit on a ledge to catch your breath and reassess your gear.
That's a great way to look at it.
Right. On a 4-hour chart, zooming in on that specific moment makes it look like you were teetering on a cliff edge, about to fall backward. But the 1-year macro picture shows you are still sitting very comfortably above base camp.
What's fascinating here is the severe friction between those two time frames and really how different market participants exploit it.
Oh, totally. Because they are playing completely different games.
Yeah, exactly. High-frequency algorithms and retail day traders operating on the 4-hour time frame are reacting to acute downward momentum.
They're just seeing the red.
Yeah, they are hitting bids, liquidating positions, and driving that intraday slide. But institutional asset managers, the ones actually looking at the 1-year chart, they aren't panicking at all.
Not even a little bit.
No. They view 1,100-point drop not as a collapse, but as a necessary mean reversion after a 25% rally. It's basically a liquidity grab.
I want to push back on that slightly, though. Like, is it purely a mechanical mean reversion, or are we seeing actual structural weakness at the top?
That's fair.
Because 1,100-point drop with those incredibly heavy volume bars suggests there's real conviction on the sell side. It doesn't look like they're just trimming positions, It looks like aggressive profit-taking ahead of perceived macroeconomic headwinds.
It's a very fair challenge, and the volume profile certainly supports heavy distribution. But this exact macro volatility, this tension of the broader index taking a heavy breather while testing lower liquidity zones, it really sets the stage for the bizarre individual stock behaviors we need to dissect.
Oh, man. Yeah, it does.
Because when the broader market bleeds like this, correlation usually goes to 1, meaning most equities should be dragged down right along with it.
Which brings us perfectly to the heavy infrastructure sector.
Yeah.
Because correlation is absolutely breaking down in the cement industry today.
It really is. It's wild to see.
We have 2 major players operating in the exact same macro environment, yet their charts look like they belong to entirely different markets.
Yeah.
We're looking at DG Con Cement Company, DGKC, and Lucky Cement Limited, LUCK.
The divergence here is just a textbook case of technical positioning completely overriding sector sentiment.
Let's break down DGKC first. It's trading at 212.11 and is caught in this pronounced short-term downward slide.
Yeah, it's really struggling right now.
It is still technically within a broader upward channel, but right now the momentum is undeniably bearish. It is falling toward a major support zone at 208.24, and it just looks heavy, like no buyers are stepping in at all.
They aren't stepping in because the risk-to-reward ratio just doesn't make sense yet. At 212, you are basically in no man's land.
Right. It's just floating there.
Exactly. The algorithm sees the liquidity pool sitting way down at 208.24, so why bid the stock up at 212 when you know the broader market headwind is likely to push it down to 208 anyway?
But then, okay, look at Lucky Cement. On a day when the KSE-100 is shedding 1,100 points, LUCK is incredibly buoyant.
It's having a great day.
It's up 2.01%, trading at 443.40. So I have to ask, if the broader market is bleeding out and both these companies are exposed to the same domestic infrastructure spending, same supply chain costs, why is DG Con acting like an anchor while Lucky Cement catches a 2% bid?
It's a great question.
Wait, is retail really waking up and deciding Lucky is just fundamentally superior today?
No. Retail has very little to do with a move like this. You have to look at the momentum oscillators, specifically the stochastic RSI on Lucky Cement.
Okay, tell me about the RSI.
Well, entering the session, LUCK's stochastic was buried in deeply oversold territory. It was printing around 10.65 and 8.23.
Which basically means the selling pressure had completely exhausted itself.
It means more than just exhaustion. It means the short side trade became overcrowded. Everyone who was going to sell had already sold.
Oh, I see.
And more importantly, the short sellers had pressed their positions as far as they could. Right as that momentum oscillator bottomed out, Lucky Cement's price intersected with a massive historical support line near 438.24.
Okay, let's pause right there for a second.
Yeah.
Because a lot of people call support a psychological safety net. But I've always found that explanation a bit, I don't know, hollow.
Yeah, it's a bit too fluffy.
Right. It's not just traders feeling warm and fuzzy about a random line on a chart. We are talking about hard market mechanics here.
Absolutely. It's not feelings, it's order flow. That 438 level on LUCK is where institutional algorithms have clustered massive tools of resting limit orders.
Like a literal safety net made of cash.
Exactly. Additionally, the short sellers who rode the stock down into oversold territory, well, they use that exact same support level as their target to cover their positions.
So to cover a short, they literally have to buy the stock back.
Exactly. So you have this huge convergence, you have programmed buy limit orders executing, and you have a flurry of short covering, which artificially floods the market with buy orders.
Wow.
Yeah, this mechanical demand traps whatever late sellers are still out there, triggering a really sharp bounce. That liquidity grab is what drives LUCK up 2%, completely ignoring the bleeding KSE index.
That makes so much more sense. It's a mechanical reaction to a technical extreme. Timing and order book positioning just completely override the macro gravity.
Yeah, the macro doesn't even matter at that specific second.
Meanwhile, DGKC hasn't hit its limit order cluster at 208 yet, so it just continues to drift lower, totally starved of that artificial buying pressure. The buyers are just sitting on their hands, waiting for their own mechanical triggers to hit.
It proves that in highly volatile markets, the chart structure often dictates the price action way before the fundamentals even have a chance to speak.
So, if the infrastructure sector is actively battling over these deep liquidity zones, where is the institutional capital hiding out while it waits for the index to settle?
You'd be surprised where it parks itself.
Because we have a trio of charts from the legacy staples. We're talking Pakistan State Oil, Gandhara Tire and Rubber, and Pak Telecom PTC. And they're all acting remarkably lethargic.
Lethargic is honestly the perfect word for it. These are the heavy, slow-moving gears of the economy. Energy, transport components, communications.
Right. And right now, their price action is completely paralyzed.
Let's run through them really quickly. Pakistan State Oil, PSO, is sitting at 354.00, just barely clinging to a support level at 352.67.
Barely hanging on. And Gandhara Tire, GTYR, is at 33.50, nervously hugging the absolute lower boundary of its trend line. But here's where it gets really interesting.
Oh yeah, this one is fascinating.
Pak Telecom. PTC is trading at 71.36, and its chart looks like the heartbeat monitor of a sleeping giant.
That's a vivid way to put it, but it's accurate.
It is just ping-ponging sideways in this incredibly tight, rigid channel between 67 and 75. and its standard RSI is dead neutral at 52.41.
If we connect this to the bigger picture, what you're observing with PTC is a textbook phase of institutional consolidation.
So what does that actually mean for the chart?
Well, when you see an RSI pinned at 52.41 for an extended period, it tells you that market makers are entirely in control of the price discovery,
Meaning they're actively suppressing volatility.
meaning they are absorbing it. In a consolidation phase like this, institutions are typically either accumulating or distributing a massive position. If they buy too fast, they drive the price above 75, which ruins their average entry cost. If they let it drop below 67, they trigger retail panic and destroy the asset's technical structure.
So it's a very delicate balancing act.
Exactly. So they deploy algorithms to buy the dips at 67 and sell the rips at 75, keeping the price trapped in that narrow hallway.
I look at that 52 RSI,
Mm-hmm.
and it just screams stalemate to me.
Yeah.
Neither the bulls nor the bears have the leverage to force a breakout.
It's a total tug of war.
But I struggle with the idea that this can go on indefinitely. Like, is the broader market just waiting for a catalyst to break the algorithm's grip on PTC?
Usually, yeah. A tight consolidation range like that is broken by an exogenous shock, an earnings surprise, a regulatory shift, or maybe a sudden change in interest rate expectation.
Right, something to upset the balance.
But until that data drops, the algorithms will just continue to farm the volatility between 67 and 75.
It's a coiled spring then. The longer a stock moves sideways and compresses that energy, the more violent the eventual breakout or breakdown tends to be.
Right. Oh, absolutely. The compression builds the momentum.
Because once it finally cracks 75, all those algorithms that were shorting the top of the range suddenly have to buy to cover, which fuels a massive spike.
That is the exact mechanism. You are building up a massive reserve of kinetic energy. When the range finally snaps, the resulting momentum can be incredibly aggressive.
Well, if PTC is a coiled spring waiting to pop, the holding and property sector is where the spring has already exploded, and in two completely opposite directions.
Yeah, this sector is putting on a wild show today.
We really need to dissect the divergence between TPL Corp Ltd. And TPL Properties Ltd. Because honestly, the disparity here is breathtaking.
It is the starkest contrast in our entire stack today. Let's start with the holding company. TPL Corp is getting decimated.
It is down a brutal 4.64%, crashing down to 19.98. And the chart shows a vicious rejection at a resistance ceiling near 20.54.
Vicious is the right word.
It tried to push through that level, failed spectacularly, and then the bottom just fell out.
That rejection at 20.54 is crucial to understand. We talked about support being a floor of limit buy orders earlier, right?
Yeah, the safety net.
Well, resistance is the exact inverse. That 20.54 level was loaded with iceberg orders.
Iceberg orders,
Yeah.
like hiding under the surface.
Exactly. Massive institutional sell orders hidden from the broader order book. When TPL Corp pushed into that zone, those sell algorithms activated and flooded the market with supply. The buying demand just couldn't absorb it, and the structure collapsed.
It's like hitting a reinforced glass ceiling. The moment it cracked its head on 20.54, all the retail traders who bought the breakout realized they were trapped, and they all scrambled for the exit at the same time.
Yeah, a total panic liquidation.
But contrast that absolute bloodbath with its sister ticker, TPL Properties, TPLP. It is experiencing a completely euphoric breakout. It gapped up to 14.91 today.
A gap up is arguably the most aggressive technical maneuver a stock can make. It means the buying pressure in the pre-market or between sessions was so overwhelming that the opening price completely bypassed the standard limit book.
So it didn't even trade up to 14.91.
No, it teleported there.
Teleported is right. But I have a major red flag waving on this chart.
Oh, what are you seeing?
We've been discussing momentum oscillators all day, and TPLP's RSI is currently sitting at a scorching 74.95. Wait, is this the stock chart equivalent of Icarus flying way too close to the sun?
That's a really good analogy.
Because buying a gap-up breakout at a 75 RSI feels like you are just offering yourself up as exit liquidity for the smart money.
That is highly astute read. An RSI pushing 75 confirms the asset is in a deeply overbought state.
Which means danger.
Usually, yes. Now, to be fair to the momentum traders, a stock can remain overbought for extended periods during a legitimate structural breakout. The algorithms can lock the RSI above 70 and just keep grinding the price higher.
But the risk asymmetry becomes massive, right?
Exactly. The kinetic energy required to sustain a gap up at those RSI levels is immense. Eventually, the buyers just exhaust themselves.
And then what happens?
The early institutional money that accumulated the stock way down in the 50 RSI range looks at their screens, sees the euphoria, and begins to methodically distribute their shares right into the retail buying frenzy.
And when that institutional distribution outweighs the retail demand, gravity just takes over. The buying dries up, and you get exactly what we just saw happen to TPL Corp.
Precisely. TPL Corp was pushing its own momentum boundaries before it slammed into that 20.54 iceberg. The reality check was instantaneous.
Just a total wall.
It shows how rapidly an algorithmic momentum trade can invert into a panicked liquidation. One moment you are chasing a breakout, and the next you are down nearly 5% because the smart money decided it was time to cash out.
So what does this all mean? I mean, we started this deep dive by talking about tapping into the collective nervous system of the market.
We did.
And zooming out on these 9 charts, we've witnessed a total masterclass in market microstructure. We saw the macro KSE-100 benchmark endure a heavy 1,100-point algorithmic profit-taking session after a grueling 24% yearly climb.
A massive breather for the index.
Right. And then we saw GG Cement sliding into a liquidity void, while Lucky Cement violently bounced off a 438 support level fueled by short covering and limit order fills.
Mechanical extreme reactions.
Yep, we watched PAC Telecom get pinned in a 67 to 75 range by market makers, just absorbing the volatility. And finally, we saw the extreme gap-up euphoria of TPL properties flying close to the sun, contrasted right alongside the brutal iceberg-induced reality check of TPL Corp.
This raises an important question, though. If you are listening to this and you primarily trade completely different indices, or perhaps you focus on longer-term macro trends rather than these intraday swings, why is granular technical divergence on the PSX even relevant to your thesis?
Right. Why obsess over a stochastic bounce on a cement stock in South Asia?
Because the mechanics of liquidity, order flow, and human behavioral bias are entirely universal. An algorithm programmed to hunt for stop losses behaves the exact same way in Karachi as it does in New York or London.
It's all the same underlying math.
It is. These charts, the volume profiles, the RSI extremes, the hidden iceberg orders at resistance, they are the architectural blueprints of modern capital markets. When you understand why a stock bounces off a specific line, you realize it isn't magic. It's a measurable collision of fear, greed, and pre-programmed execution.
The architectural blueprint of capital. I love that framing. And honestly, it forces you to think about how these exact same forces govern systems way outside of the financial markets.
No. Like what?
Think about your own operational output. If someone plotted a candlestick chart of your daily energy, your focus, or just your overall productivity, what would your underlying trend lines look like today?
That's a deep question.
Are you currently exhausted, sliding down toward a baseline level of support,
Right.
relying on your core habits just to keep from completely breaking down? Or are you pushing aggressively against your own mental resistance ceiling, flashing a dangerously overbought RSI of 75, just one external shock away from an Icarus-style burnout?
A really fascinating way to contextualize the data.
Because the mechanics of exhaustion and momentum apply to human capital just as ruthlessly as they apply to financial capital. It might be worth auditing your own personal indicators today.
Absolutely. Good advice.
Thanks for diving into the order books and the mechanics with us today. We'll be back with another stack of charts soon. Until then, keep an eye on your trend lines.